ODFL is looking like a phenomenal company that you need to have in your watch list. This needs to be a company on your radar. We're going to run through this company, which is up around 45% year to date. Now, when we look at the financial metrics, you're going to understand the hype about this company and why they are up so much and the incredible nature of Old Dominion Freight Line. Now, in today's episode, we are going to look at the historical performance of the company. We're going to take a look at their income statement, their top line growth year on year, as well as that bottom line. We're going to jump into their balance sheet, do a very quick snapshot of their health, their total cash versus total debt. We are going to look at their dividend safety and some very important financial metrics you need to understand for ODFL. And as always, we will run it through our stock valuation model, getting to our intrinsic value, our acceptable buy price, and our margin of safety. Now, it is up around 45% year to date. It is towards the mid to upper end of the 52-week range. However, for regular viewers, you'll understand that 52-week high does not signal overvaluation. It does have a yield, however, fairly small at 0.39%. And for investors who have been holding the company over the last 10 years would have seen incredible growth, 1,192%. Now, what we want to understand in today's episode is if we lock in price that we see right now, can we expect to see incredible growth over the next 10 years, bearing in mind that the market cap is only 45 billion. This in turn will also affect that yield on cost that we hope over time to see in the double digits. Now, in terms of the business itself and that top line, what we like to see is around 3 to 7% growth year on year. December 2018, around 4 billion on the top line. December 2022, around 6.3 billion. So what we can see over the period is more than a 50% growth on the top line over the last 5 years. On a more granular level, though, do note that from 2018 to 2020, the growth was fairly flat, as we can see here, before picking up in 2021 and then 2022. Now, in terms of the bottom line, their net income, how does that compare? Well, 606 million in 2018 on that all-important bottom line. 5 years later, 1.4 billion. So more than doubled their bottom line over the last 5 years. Again, we can see fairly flat over 18 to 20, that period. But again, it picks up from 21 and 2022. So some incredible notes to take there and to understand about the business. Then when we look at the balance sheet, a quick snapshot of their health. Total cash in 2018 was around 190 million. Latest quarterly report, we see around 55 million. So it has decreased over the last 5 years. And in terms of their total debt, how does that compare numerically and directionally? Well, they had around 45 million worth of total debt in 2018. And it's nearly doubled that in their latest quarterly report, around 80 million. So let's understand how this affects their dividend safety and understand some of their very important financial metrics. Dividend safety score, 81, making it very safe. Market cap, 44.6 billion, making it a large cap company. Hopefully we end up seeing 440 billion. And in terms of some key metrics for those that believe we're heading into a recession, well, the last recession, they didn't pay a dividend, so there's no comparative data. Recession sales, however, was negative 19%, below the average growth rate for companies in the S&P 500 during the 07-09 recession. Interestingly, though, even though it was negative 19% below the average growth, it still beat the S&P 500, which had a negative 55% return, coming in at negative 22%. So do bear that in mind if you believe a recession is looming. Now, they've been paying dividends and growing dividends for the last 5 years, an incredible 33% increase in the dividend in February 23 this year. The last 5 years, 35%. I always say, interestingly, minimum of 4% in your dividends, salary, other income producing assets over the last 40 years. The US inflation rate was 4%. So if you are getting anything less than that, you are taking a pay cut and losing your purchasing power. Now, I would be surprised if anyone is getting on average over the last 5 years a 35% increase in their dividends or their salary or any other income producing assets. So very, very strong start so far. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. What we can see here, fairly in line, so you could say reasonably valued. However, as always, we never look at any model in isolation and we'll draw our conclusions towards the end of the episode. Likewise, forward PE 34.5 over the 5-year average. So this is one sign of overvaluation that we can see. And in terms of the sector PE, it's significantly higher than that of the industrials at 17.8. As I mentioned at the beginning of the episode, it is towards the 52-week high. However, do understand 52-week high does not signal overvaluation. 52-week low does not signal undervaluation. Now, earnings versus free cash flow. Regular viewers understand we tend to ignore the earnings purely based on the fact that it is susceptible to manipulation by management. So I prefer to look at the free cash flow metric, more appropriate and accurate in my opinion. Below 60% is what I personally look for because it means, in my opinion, management have room to be able to grow those dividends to double digits that we love to see as investors. For the large part, it's been even below 20%, with 2023 expected at 18%. So very, very strong that they're only paying out around 15% in 2022, yet their dividend increase in 2022 was 35%. So very, very positive to see. Free cash flow per share, again, EPS is there for investors who want to see the data. 43 cents in 2013, 8.16 in 2022, with 2023 expected to be 9.01. So very, very strong growth over the last 10 years and going in the right direction. Very positive to see. Then we move on to the sales growth. 3 to 7% growth is what we look year on year. What we can see for the large part, they've beaten that every single year. We do see 2019 to 2020 a fairly poor year alongside 2016, but other than that, we see some strong years of double-digit growth. Numerically, 2.3 billion of sales, that top line in 2013, nearly 3 times as much growth, 6.3 billion in 2022. So it is going in the right direction and it is growing at a very strong rate. So very positive to see for investors. Now, shares outstanding, we love it as investors when companies do share buybacks, returning excess cash to shareholder pockets. What we can see here, 129 million shares outstanding in 2013, 113 in 2022. So they do some very, very small amount of share buybacks. Nothing really to note. Positive in the sense it's not flat, so do bear that in mind. ROIC, one of my 7 golden dividend metrics, with a return on invested capital that I look for around 10% plus, as I believe that 10% plus gives me faith that management are able to effectively allocate that capital. Check the pinned YouTube video if you want to see my other 6. Very positive, between 20 to 44%, so very, very good in terms of management in my opinion, and gives me faith for the long run so far. Operating margin, we look for around 12%. We can see not only has it been above that, but it's consistently getting higher and higher. Very, very positive. And if they continue to keep that upward trend, this will in fact also increase their bottom line, that net income, which will help with that dividend payment as well as that dividend safety score. Now, likewise, the same story with the free cash flow margin. Whilst we look for 5%, the beginning years we can see in terms of the data, it was below that. It has picked up and it is around 13 to 15% over the last few years. Very, very positive to see. Now, one of the most important metrics in terms of debt is the net debt to earnings before interest, tax, depreciation, amortization, with 3 being our threshold, 3 being the number of years it would take the company to pay off all their debt net of cash on hand. What we can see, essentially, it would take them not even 1 day if they wanted to pay off all their debt. So very strong and signals again to me that that dividend is very safe. Net debt to capital, purely showing the percentage of a company's financing from debt as opposed to equity. As always, if you are enjoying the content, value is being provided, smash that like button, hit that subscribe button to be continually notified of these videos, and hit the bell button to have these delivered to your doorstep. And if you want to grab a copy of the valuation model to run your own companies through to get your own intrinsic value, do click on the pinned description below. Now, the first model we're using is Graham's Valuation. We have the stock ticker ODFL, earnings per share 11.5, with growth rate per analyst estimates and that ever-increasing yield on AAA corporate bonds. Now, the intrinsic value is coming to around $165. And as I've mentioned in previous videos, Graham's Valuation is starting to become a slightly outdated model, and therefore we will be removing it from our intrinsic value calculation at the end. However, again, if you do pick up the model, you can play around, and if you want to include Graham's Valuation, you can. But just to show you, $165, significantly below the current trading price and well below that 52-week low we've seen. Now, the first model we're using, the multiples valuation model, companies in a similar sector and size, Knight Swift Transportations, JB Hunt, Expeditors, and CH Robinson. We have their stock price, earnings per share, and their PE multiples. We have the average PE multiplied by the earnings per share of ODFL, giving our first multiples valuation price of $218. Now, what we can see, it signals that the current trading price is overvalued and it should be worth slightly lower than that 52-week low. Again, we never look at any model in isolation. So now we're running into the dividend discount model where we have the yearly dividends over the last few years. We can see some incredible growth rate over the period. Again, very, very strong. Now, the growth rate here at 7.75% is what I've put in. Again, if you want to justify a higher or lower percentage, then you're more than welcome to do so. You can grab a copy of the model and play. However, based on my estimates and judgments, this gives a DDM price of $690. As we can see, showing some strong upside to the current trading price and above that 52-week high that we have seen not too long ago. We then move on to the third and final model that we're using today, the discounted cash flow model, DCF model. We have our free cash flows year on year with the average growth rate at negative 5%. Now, forward looking, analysts are estimating around 18%, and in conjunction with our discount rate, we get the present value of future free cash flows and terminal value. Add that together with the cash, subtract total debt, we get to our equity value. Divide that by the shares outstanding, we get the DCF price of around $484. Again, signaling some nice upside to the current trading price, around 20%, and showing the current market value to be slightly undervalued. Now, the intrinsic value is essentially the average of the models that we have just gone through. And as I mentioned, if you do enjoy the content, it really helps. Smash that like button and do subscribe if you want to join this wonderful community. Now, the intrinsic value, $464. We have the current trading price at around $408. Now, typically, margin of safety, I would advise 10% if you're looking for, if you believe, in fact, it has a wide moat, strong financial metrics, good forward-looking data. Now, 10% personally for this company, I would say you could go higher. So those who are looking at around 15%, your acceptable buy would be around $394, signaling it's not a buy just yet. And for those who are looking at 20%, again, $371. And those who want more comfort at 25%, $348. Now, we can take a look, 348 is still within that 52-week range. Not to mean that it will come back to that price, but just to make you aware. Now, Wall Street are forecasting the price over the next 12 months to hit around $422. So they believe currently to be limited upside, just below around 5%. But as always, let me know your thoughts in the comments below. Are you looking to add ODFL, looking to sell, or purely on the sideline speculating, or even if you're adding it to your watch list? As always, drop your comments, do like if you enjoyed today's episode, and do subscribe if you haven't already. And finally, if you do want to run your own companies through to get your own intrinsic value and your own acceptable buy price, do grab a copy of the model in the pinned description below. As always, have a great day, catch you on the next episode, and take care.